Welcome to Multifamily Method, a podcast which explores the state of the multifamily real estate market and some of the backgrounds, methodologies, and words of wisdom from some of today's most successful multifamily real estate entrepreneurs nationwide.
What's interesting about being a deal professional in our industry is we always think that you need to have, and I say this too, that you need to be older and you have to have a ton of reps. And that's sometimes true, but I've seen it where you put somebody who's got real promise, talent, drive, intuition, you can assess that at whether you have that at a young age or not. You throw them into the deep end of the pool and they're generally going to swim. I would push anybody who's of the mindset of you got to be, in your 30s to be a qualified deal professional. That's not true.
Welcome, everybody. Today we have Dave Welk in the studio with us. How you doing today, Dave?
Doing great. Thanks for having me.
Great. Dave is the managing director for acquisitions from Origin Investments, which coincidentally is right down the street from our headquarters in Charlotte. And we're looking forward to talking to you, learning a little bit more about you, about Origin, and talk about the state of the market and whatever else we ramble across today. So just tell us a little bit about, we were just talking about it before we got started. Tell us a little bit about your background and then maybe a little bit about Origin as well.
Sure. Yeah. As we were just mentioning, you were asking, you saw my bio that I'm a Hawkeye fan. I'm very proud Hawkeye fan at that. I grew up in South Dakota. As I was saying before, that I'm usually everyone's first person they've ever met from the state of South Dakota. So I hope to represent the great people there well. But some of my interests still to this day are going back to go pheasant hunting. I still see my parents there. They're based in Sioux Falls, South Dakota. So a good place to grow up, good place to be from, and good place to leave as you get older too. And then I moved to Chicago after graduation and was there for 15 years before leaving to move to Charlotte, and love it. Love being a Southerner, love being from the Midwest, but I feel like I was a misplaced Southerner stuck in the Midwest for 30 some odd years, but we're definitely at home here in Charlotte. Love being here.
We got three Midwesterners on because Bryce is from South Bend, I'm from Cleveland, and I'm a Buckeye fan, which I'm sure doesn't make you very happy.
No, and it's funny because my oldest son, who's become a rabid Panther fan living here, and my middle child's my Hawkeye fan, and for my oldest, he's out to spite me. So he loves the Buckeyes, only because I don't like him. So he's become a huge Buckeye fan. I'm like, I will not pay for you to go to school there. You're gonna have to get your own scholarship.
Let me guess, no Irish fans in the family, huh?
No, we grew up Catholic, and I feel like when you're Catholic, you go one way or the other. You totally embrace the Irish or you hate them, depending on your which side of the fence you fall. And I'm on the generally on the hating side. Although I will say that there's no play if you're a fan of college football like I am, there's no experience like going to a game in South Bend. It must be done.
You recovered well, thanks.
You bet.
Cool. Well, tell us a little bit about Origin then.
Yeah, so Origin it's a great story. I joined the company a little over 10 years ago, and prior to that, I was with Deutsche Bank's real estate investment advisory group called REEF, so a large pension fund advisor. And I'll say that, effectively that's where I really cut my teeth on commercial real estate, and I got a PhD in pension fund advising, institutional core investing, value add, and development. I really got a great exposure to larger deals, to an institutionalized way of investing capital, and then exposure to all the markets throughout the country. I mean, I started in portfolio management there on a couple large separate accounts for City and County of San Francisco's pension fund and AT&T. And had all four main food groups in markets throughout major markets throughout the U.S. So really got my a great education on how to invest professionally in real estate there. And then I joined the acquisitions group, and was there for most of my career at REEF. And I'd spent my time really in kind of the central and southeastern U.S. So I had some really good relationships and market knowledge that I picked up at Reef. And while I was there, I was there through the GFC. And one of the best things that Reef provided for me was, and several of my colleagues, is that they paid for our graduate programs. So I went to DePaul and got my master's degree in Master of Science in Real Estate. And unfortunately for Deutsche Bank, that's where I met Michael Epscope, who's one of our co-founders at Origin. And Michael, along with our other co-founder, David Shear, had started the company really as a family office to put out their own capital. And I didn't really know what a family office was, by the way. I knew what it was to be a large pension fund and have a conventional allocation to stocks and bonds and commercial real estate. But I didn't realize that if you were a wealthy individual, you start your own, effectively your own investment platform, invest in your own capital, and then ideally hire folks who are professionals to help you make investment decisions. So Dave and Michael started Origin as a family office, and that was around 08, 09. So interesting time to start a real estate investment platform, but in a lot of respects, it was the best time to start one. And so I met Michael at grad school, and he took one of our papers that we had written on buying distressed notes from credit unions in Florida. We found the idea out. He literally took the idea and put his own money behind it with David and bought 110 homes in Coral Gables, Florida. I'm sorry, not Coral Gables, in Cape Coral, Florida, which is outside of Fort Myers. And I was like, who is this guy? He took our business plan and put his own money behind it. So fast forward a year or so later, Michael asked if I wanted to help come on board and take Origin from a family office and really put some institutional, policies and procedures and protocols into place and start raising a series of funds. So kind of converting the platform from a family office to a bona fide investment management company. And that was 10 years ago. And it's been an awesome wild ride ever since.
That's great, man. That's great. So, I guess what's happening to, spinning it forward to today, like really, what are you focused on today? What's happening in your world? How are you having an easy time getting capital out?
That feels like a loaded question. So this actually seemingly simple question. And frankly, it's one of the hardest things for myself and my colleagues to distill down quickly and succinctly, because we have so much going on at Origin and we have so many different verticals that we have access to. It's hard to, really and I'll do my best here, but, so kind of pulling forward, from what I was just answering on how we started, we were really we went from a series of, multiple markets throughout the country, kind of opportunistically chasing deals without a ton of discipline on the investment side. But very quickly we reined that in and we focused on two asset classes. It was really multifamily and office. And we winnowed down the world from, any opportunistic deal to 12 markets. And we started putting real science behind where we were investing. And so the reason why we picked those two is we love the fundamentals of multifamily intrinsically, and B, we had a lot of experience internally within Origin on the office side. We hired two folks early on who had experience at Equity Office and Blackstone. I had done a number of office investments when I was at Reef, so it made sense because we knew the markets, we knew the fundamentals. So those were our two initial asset classes. We pivoted to kind of a hub and spoke model around 2015, which is when I moved to Charlotte. And around that time, we opened up two more offices. We opened up an office in Dallas and then one in Denver. And to this day, we have those three regional offices in addition to one that we've opened in Nashville. And we believed early on that, a boots on the ground approach is just better, right? So a lot of investment allocators are based in New York, some certainly in San Francisco, LA, Chicago, but real estate's a local business, as we all know, and it's a relationship. It's cliche, we say it all the time, it's a relationship business. It truly is, in a way that The equity and fixed income businesses are not as much. That's more transactional. This is block by block, street by street, knowing your relationships. And so we just thought if we're going to have a competitive advantage, it's got to be that. We need to know our markets inside and out. And so we set up shop and put folks in our regions. And so most of our infrastructure is and still is in Chicago on everything non-investment side. But our investment folks are in the market for a reason. So along with that said, we've kind of now going pre-COVID saw office as being a struggling investment long-term. And we've switched from a buy, fix, and hold type model from a buy and fix and sell, which is really our closed-ended funds, which have a finite amount of period of time you can hold an investment, to a build and hold model or a buy and hold model. Because we believe, and we are some of the largest investors in our funds, our principals and ourselves, that's a better way to own real estate, right? So you're creating the value. It's hard enough to find a deal. To answer your question, no, it's not easy to put out capital. We have unprecedented wall of capital that the likes of which we've never seen before. So when you get a deal or you build a deal, especially when you develop something, it takes a lot of brain damage to get something out of the ground. Why do you want to go turn around and sell it right away? I mean, I get it, why folks do. There's a promote to be earned, or you have a closed-ended fund that requires you to do it. But we have pivoted our strategy at Origin because we want to do it this way. And frankly, our investors have said they also want to invest this way as well, which is it's more efficient to have your capital always at work and you get to refi. Money comes back tax-free. It's a great way to own real estate and accumulate long-term wealth and scale. So that's our model today, is really more the build and hold, buy and hold strategy. And within that, I can go into several details on what we're doing, but that's kind of the high level. Distilled down, we really have 3 buckets of capital. We have our evergreen, open-ended core plus fund that we can do a lot of different things with. We can do a little bit of development. We have a 20% allocation within that fund to development deals. We're doing mostly preferred equity right now on development projects within that fund. And we can also buy core, newly built stabilized assets. But the goal of that fund is long-term holds. We're just launching now. We still believe in the closed-ended fund model, but not as our primary source of capital. But that's a market rate development fund providing JV capital to developers, but we can do some interesting things that some of our larger institutional peers cannot, which is we can get in early, take down land, assist in pre-development costs. We can get pretty opportunistic within that fund. And we just launched that last week. And then lastly, we have an opportunity zone fund, which targets, obviously by nature, opportunity zone eligible investments. But by virtue of it being an OZ fund, 10-year holds, it kind of lends itself to that longer term, long dated structure. So those are where we're playing, and we're in terms of markets. I can go deeper in this later, but we've really gone nerdy on the science side of things, and we've hired 2 remarkable data science folks that have developed machine learning for us in terms of helping us not only select markets, but select block by block, using 4 to 5 billion pieces of data, running spatial analytics, and helping us kind of corroborate our boots on the ground strategy that we have folks there, but we also want to corroborate our gut at the end of the day. And we have a really cool tool that helps us do that on a daily basis.
A lot to unpack there. So I have several questions rattling around in my head after that. I think the first 2 that immediately jump out to me are, does the buy and hold or build and hold strategy limit your ability to get capital out, especially on the development side, because the majority of developers anymore are merchant developers, and how is that working for you? And then maybe expand a little bit more on how successful or what opportunities you've seen in the QOZ fund, because everybody's heard about it for several years now, but I don't know a lot of people that are actively creating a strategy around it.
Sure. Yeah. On the first one, great question. Developers still want to develop. Developers still want to get paid to promote, and they're generally not in it for the long term. So That's what's always been interesting to me, and we played one awesome facet of Origin is that we're probably the hallmark of our company is that we're creative and flexible on where we put our capital. So we've been on every side of the coin. We've co-developed, so we're certainly incentivized as a GP in some deals. We've been an LP, we've self-performed, we do pref. I mean, the only thing we don't do is mezz, but I think it gives us a really good lens when we're creating investment structures because we know what we want, again, when we play on both sides of the aisle. So we have that in mind when we create these funds. And what's been interesting is there's been a lot of overlap between this OZ fund because by virtue of a developer can't get out. Right? We can't sell the asset. So we have to create a mechanism where they get paid their promote, but we don't violate any of the OZ, regulations for minimum 7, but ideally 10-year plus holds. So it's something that, that's become more and more common in the industry called the crystallization event, right? So basically what we do is we simulate a sale and we have a lockout period and we're starting to do this on our non-OZ deals. And we are getting developers who are on board for this. And the devil's always in the details. But basically the way it works is you're going to be locked out of selling the asset for the first 42, 48 months. And there's basically a put window where the developer can say, all right, I'm ready to sell. The project's stabilized. And what we'll do is we'll go refinance the asset. But we'll determine what market value is and we'll run the promote then based on what the value would be if we had sold it. We can go into detail on are you really getting full market value? But generally speaking, we can come to terms with our development partners on what that is. And then you'd run the promote like you were selling it. So they would figure out what they're due. And if we have enough proceeds from the refinance, we'll pay them out. In a lot of cases, and we give them the option to stay in for all the reasons that we like to stay in some of these investments. I mean, think about it. If you're the developer and you put the deal together, you get a lot of pride in it. Like, okay, maybe I'll take half to 3/4 of my chips off the table, but I like to stay in this deal long term. So we give them that option to stay in with us and enjoy the same depreciation benefits and all the reasons why we love owning real estate long term. So that is afforded to a lot of our partners, and that's not for everyone. But we're seeing increasingly more and more developers. They certainly get that. That's the game on the OZ. It's implied. But on market rate deals, they're also starting to see the value of that as well. And then I think your other question was on, let's see, it was
just on the OZs.
On the OZ.
Like building a strategy around that.
Yeah, and when we were one of the first groups that I know of in the country that was really starting to build a fund and strategy around opportunity zone investing. And we were turned on to the entire space by actually a deal here in Charlotte. That was our first OZ deal. I was poking around on an adaptive reuse building up in the Notice submarket, which at the Sugar Creek station. And there was a local land assembler here who was trying to get a number of projects, adaptive reuse, office, retail, and owned and assembled, at the time, upwards of 80 to 90 acres of land. In the area that was, where the new light rail track was getting laid. And if you followed Charlotte, what happened when the South Belt, Blue Line, was laid in South End here, I mean, that created, the most dynamic explosion of investment in Charlotte's history in terms of real estate. And, it didn't take a whole lot of foresight to say, all right, well, if that worked for the South, it's probably gonna work for the North. And our partner here definitely went in, put chips in the middle of the table, and assembled or put together a huge land assemblage up there. So he's the one actually, and then he didn't know that the OZ was going to get passed during the Trump administration, but the gift of manna came down from heaven, and he got all of his dirt was put in the OZ. And so while we were looking at that project, we started to understand what that really was. And then we were like, wow, this is tax efficient in a meaningful way. It's going to unlock a tremendous amount of capital because everybody knew about 1031 forever. That's been around as a tax advantage, but never could you sell Facebook stock and roll those capital gains into a piece of real estate. That's pretty cool. So you can or sell a business and take those capital gains and roll that into real estate. So we in most of our investors are taxed, right? They're not pension fund clients when I was at Deutsche Bank. So we're like, what a great strategy for our investors. I mean, they're going to love this. There's huge tax advantages. And it just so happened that we were looking in these areas, and a lot of the markets that we're in happened to be crossovered within the opportunity zone. So there was definitely a lot of scuttlebutt, a lot of discussion early when OZ came about, kind of flash in the pan. But there's definitely been a few groups who've really emerged as focused on that strategy, and we're, as far as I know, we're probably top 2 or 3 in the country in terms of size and activity within the opportunity zone space. And we just closed out our first fund at the end of last year, and we started raising capital for our second fund. Fund 1 was about $270 million of equity. It'll be about $800 million of total gross capitalization. And Fund 2 probably will be about $300 million of equity and about $1 billion of gross capitalization. And we're still seeing opportunities out there. A lot will say it's been picked over, and that's somewhat true. But what's been really interesting for us is when we can find larger sites that we can phase over time. And that was the Charlotte deal. The Charlotte deal at full build out will be 1,000 units across 3 to 4 phases. Could be a little bit more than that, depending on if the market throws us a bone and we get more density. But we've got another project in Nashville that we just closed on, great OZ site. And then we've got another site in Atlanta that I'm very excited about. Could be hoping to waive diligence at the end of this month, but that could be 1,500 units, 4 phases, adaptive reuse, some commercial, and it's in the path of growth. Like, it's not like we're having to hold our nose and hope that, in 10 years it comes our way. The Nashville site, our general thesis is the OZ benefit is a cherry on top. We would have done this deal had for the OZ never existed. And frankly, that's our guidepost on when we're looking at OZ deals. And we're still finding those opportunities across our markets.
Awesome. Now, with respect to the NOTA project, what part of the stack is Origin in? You're the LP, but do you have I imagine you're in the co-GP seat as well?
We are, yeah. I mean, we're very involved in terms of getting that deal out of the ground. We were partnered with a local developer here, as I mentioned, Tony Kuhn. He was the gentleman who received the gift of manna. But I have to give him all the credit because he had the foresight and knew that this was coming. He saw it happen in South End, and he got in the way in a most meaningful way. But he didn't have a lot of vertical development experience, certainly in multifamily. So we were very involved throughout the design process, through the GC selection and negotiation. We procured the debt with our corporate lender out of Chicago, brought them here to their first deal in Charlotte. We kind of strong-armed them and said, we've got $200 million of equity in your bank, of deposits in your bank. You're coming to Charlotte to finance this deal. But so we were, from soup to nuts, super involved in that project. And it's been a great relationship with Flywheel and with Tony. And, he's learned a lot and we've learned a lot together. And it's going to be a great deal. And again, this is his vision, 20-year vision for the neighborhood. And we're starting to see real, bamboo shoots come out of the ground. And not just our project, but if you look around the NOTA neighborhood, Grub's underway on their project, which is an OZ investment for them. You've got 2 or 3 other deals that Tony has held the land and is selling to other developers that are qualifying OZ investments. I mean, it's happening all around. It's a really exciting time to be in and around NOTA. And we're just excited to be sitting right at the nexus between 2 light rail stations. The Cross Charlotte Trail is going to come ripping through there. That's going to be our, the poor man's version of the Beltline in Atlanta, which is going to get built out here, but it'll be a multimodal pedestrian trail that's going to connect our site to downtown NOTA and to the other light rail station. So it's going to be super cool. But yeah, we had a heavy hand in that project.
That's awesome. So since we're talking about specific deals, I guess what would be the most interesting or best performing deal you guys did last year?
That's a good question. Selfishly, I'm going to say the NOTA project, just only because that's been my baby for 2.5 years. It took way too long to get out of the ground, but I'm excited that it's there. But I'm going to give our team at Origin, a ton of credit because we had a record-breaking year in terms of productivity, and we are going to crush that next year, given the pipeline that we have. And we went from, development being 20% allocation from our predecessor fund. So we've been doing development for a while, but it's never been a core focus, to development only in the last 18 to 24 months. So we've really gone deep. We've learned a lot as a group, but we brought in a lot of experts where we maybe didn't have the knowledge base. Some folks that we serve as almost like internal Origin employees, but they're consultants. So last year we put out $300 million of equity and exactly $1 billion worth of deals in a year, which is pretty nuts. I mean, in the go-go days at Reef, I think our record year was $7 billion, which, if you inflation adjust that's probably like 10. But if you would have told me 10 years ago at Origin, we'd be doing $1 billion a year in transactions, I'm like, okay, when? In 2050? And we'll do $1.5 billion hopefully next year. So we had some kind of landmark closings this year for us in 21, which was the Nashville site, which will end up being a multi-phased OZ project, probably $200 million of total value. But if I were to pick one, I'd probably say Noda, because it's just been a labor of love to get that thing done.
Cool. So then we were talking off air about Rise Real Estate down in Jacksonville. So what other multifamily, since we are the multifamily method, what other multifamily developers are you guys working with across your various markets?
Yeah. So, what has been impressive too in last year is that these relationships, they take a long time to build out, right? And a lot of times you're getting shotgun married in the context of a deal. And we'd like to take a little bit more of a proactive approach to relationship formation. But we've done it. We've done it in a short period of time. And I would say that our most prolific development partner in the country right now is a group called Geffen out of Houston. And Geffen Development within certainly Houston, but Texas in general they're vertically integrated. So they have their own GC arm. And we've got 4 deals in our pipeline with them in Nashville, Phoenix, Austin, and where's our 4th one at that I'm blanking on? But yeah, I mean, we've got, it'll come to me here, but we've got a deep pipeline with those guys, and they're great. They're lean, they're mean, they don't buy, and this is going to totally upset you guys, but they don't go through a marketed process. They find owners and they just wear them down direct. So they're getting these unbelievable land buys for us, which helps everything out, especially in a rising cost environment. So they're great, and a lot of cultural overlap. Greystar
has. You want to go through a best and final on a land site?
We will if we have to for great dirt. But no, I mean, and many of our other deals have been broadly marketed sites, but one of our other prolific partners throughout the country, right behind them, has been Greystar. Kind of, very much a household name, but we just signed up our 3rd deal with Greystar, all in downtown Colorado Springs. So we're going to be the largest landowner and developer, not landowner, but developer, certainly a multifamily in the Springs downtown. And that's all happened in the last year. That's an interesting market. It's an OZ. Most of the downtown Springs is an OZ. And they have this unbelievable tax abatement provided to spur development there. So we're getting the double whammy, right? We're getting a huge abatement for either 10 or I can't remember, 12 years. So basically the entire OZ, we'll get to see the whole benefit of the abatement, tax abatement. And it's something to the tune of almost 80% of our taxes for a 10-year period. So we're getting huge yield and all the OZ benefits to boot. So those 2 are probably our 2 biggest, and then starting, develop some deep pipelines with PDG, Price Development Group, based out of Kansas City. We've got 1 deal in Nashville we broke ground on with them. And then we've got a couple more in the pipeline, and then Kaplan Residential out of Atlanta and Miami. They've become an increasingly larger partner with us, and we're looking to do a bunch of stuff with them in 22.
Cool.
In addition to Rise. Sorry, I don't want to leave those guys out.
That's okay.
Yeah.
Cool. What's a hot button topic for you right now? Like, what are you, what sort of things that are item or things that are happening in the market that is catching your interest?
Lumber. That's all we talk about all the time, every day.
Yeah.
CME Composite Lumber Future Index. Where's it going to be next month? This has been going on for a year at Origin. And our one of our co-founders, Dave Shear, likes to talk about this every day.
So what is lumber pricing today?
I should know. I think the composite, and I'll nerd out a little bit here because when people quote, okay, what's lumber at? It's $1,280. I think it's in the 1,200 range roughly. Yeah. That's kind of BS, right? Like you don't buy the composite. I mean, we've tried to. I mean, this is back to Dave and Michael being traders. They're like, I want to trade. I want to short this index. I want to go long. Yeah. Carlisle's looked at this, by the way. They can't do it. If Carlisle can't do it, probably can't be done. They would try and create a market. I'm sure they're like, Goldman, go create a market and we'll trade it. So when you quote the composite index, that's like 28 different pieces of composite lumber that go into that. When you build multifamily, you're using 2 pieces of lumber, right? You're using 2x6 and 2x4, 2x8, some 2x6s, and you're using OSB, you're using sheathing board or, effectively plywood. That's it, right? So there's not a direct correlation to the people quote, oh, lumber's back down 800. That doesn't mean that your job is going to go down. If it was at 1,200 and it went down to 800, it doesn't necessarily mean it's going to go down 40%. Yeah. But what I'll tell you, the little dirty secret that unless you're in the development business, you know this all too well, where we really been hosed is engineered trusses, roof trusses and floor trusses. We're up 2 to 3x on all of our jobs right now if we priced them 6 months ago. And why, you ask? Those stupid little metal plates that you see in the trusses, can't find them anywhere. They're jacking it up pricing all over the place because those, and if you drive by a site, I would encourage you to look at, if there's trusses laying on there, look to see if those little metal plates are uniform. They're like scrapping stuff together and just trying to bolt them on to get the trusses built. That's the world we're in right now. That's a little microcosm of the supply chain issues that we're dealing with. So trusses, lumber, tip of the spear, but it's construction pricing is what we're talking about. Yeah. And the MEP trades, by the way, your electrician, those are up 200%, 300% from a year ago. You can't find labor, skilled labor for sure. Appliances, 6 to 9 month lead time. I was on an OAC call for a NOTA deal this week. They said our TPO roof won't be available till January of next year. If we order it today, it won't be there for a year. Like that totally jacks with schedule, lead time. I mean, that's the issue du jour. Now, all wounds are healed because cap rates keep going lower, baby.
Right. It's interesting. I took a trip to Atlanta. I want to say last April or May, something in that time frame, and did the developer tour. Met with a bunch of different developers with some of our guys in Atlanta. And I can tell you, I've been selling apartments for 10, 11 years now. Prior to that trip, I never once had a conversation about lumber. And I had literally in every single meeting, we were talking about lumber pricing. So it's just like to your point, it's, if you're in the development world, it's it's topic of conversation, and it seems like it's going to continue to be for a while until this thing stabilizes.
Yeah. I mean, I would say that if to put a kind of a coin term around it, 1% increases per month in construction pricing isn't crazy. So 12% year over year, that's kind of what we're seeing in a lot of cases. What I tell investment committee to get deals approved and tell my team to do, but it's not a total BS tactic because this is the other shoe that has helped out. Shouldn't say the shoe that dropped, but it is rent growth. So a $20 increase in rents, and if you take where cap rates are at right now in the mid 3s, low 3s, a lot of our markets, which is crazy still to me to process, but you take a multiplier on that rent. I mean, you can cover $2 million of project bus with a $20 rent increase. So and so most of our deals that we're developing we're trying to play the sweet spot. We're like average rents are 1,400 to 1,700, and the Florida markets where you're in are bananas in terms of where those rents have gone in the last 2 years, especially markets like Tampa and Jacksonville. And we can talk about where dirt has gone correspondingly because the trades that are there to verify $330 a door for a stick-built 3-story deal is crazy. But if you look at where the in terms of I lost my train of thought in terms of where I was going on costs, I guess, but saying $20 a foot $20 a unit will bail you out on $2 million in costs. Most of our markets that we're in the Sun Belt have seen a 20 to 24% rent increase year over year in the last 12 months. So that's bailed out pretty much everyone who's had these major supply chain disruptions and cost increases. How long does that take, or how long does this keep going from a rental rate perspective? I can tell you our AI thinks it's going to go on for at least another year, and then we'll see what happens.
Interesting. I guess that begs the question with cost increases and rent increases, hopefully correlating. That shift. We've seen on the equity solutions team, we're underwriting a myriad of development deals. We've seen costs come in some cases 15, 20, 25% higher than we were kind of looking at a year ago. So does that shift your yield on cost expectations, or how are you dealing with that?
Yeah, I mean that's always a great question where we get a package from a developer or from an intermediary, and they're like, "Well, what's your return on costs requirements?" And I was like, "Well, I'll tell you, it's going to sound low, but it's because we always and we're not that different from most groups. Like everybody has their own little nuances on how they tweak expenses and the general contingencies they're going to underwrite, but I would say that to put a number to it, we're in the low to mid fives, right? And it's generally untrended return on cost is what we're trying to solve for. It's crazy to just let that roll off the tongue because it wasn't that long ago where 6 was the bogey you never went south of. Like, right. It was, and we always looked at it as a margin, knowing that cap rates are dynamic and they go up and they go down. So we always looked for a kind of a 30% spread on corresponding market cap rates. So to keep it simple, 4 cap, we'd want to have a 5.2 untrended return on cost. When caps were 4, we still weren't approving of deals at a 5.2. We could still find deals at a 5.5. So the math on that is more like a 40% margin. And I would say that on our underwriting still, with cost increases because of being bailed out by rents and lowering spot cap rates, we're at 40 to 50% margin right now over corresponding market cap rates still. So we're all-time margin, but that is a 5 and a 5.2 untrended, like the way that math works on a 3.25, 3.5 spot cap rate.
Well, it just kind of speaks to like how adaptable your mindset has to be as the market's shifting. I mean, our market is so dynamic right now, and I joke with buyers that you have to have amnesia to be an apartment buyer today, especially if you've been in the business for 25 years. And it's, it kind of goes along the same lines. Like if your mind is so fixed on a number for yield on cost or however you want to look at it, like you're just never going to do a deal.
Yeah. And I'll say that the way that we are getting comfortable with all this is that because we play on different sides of the spectrum, right? We understand all too well where construction pricing's at, where it was, where it's going. And we also appreciate, so to your point, so you thought about you were a buyer and you were buying, suburban multi not even a year ago. How long we've been in this COVID world? So you're buying suburban multi deals in early 20 at plus or minus 200 a door. Well, to build that project, so you can think about like, oh my gosh, it's crazy. I can't spend 260, 280 a door today, or upwards of 300 if you're in Florida or in Matthews, North Carolina, for one of our comps. But that same deal is going to cost you 260 to build today. right? On real pricing. So we know that. So we're not going to think, oh man, if it's a 300 a door and it was trading at 200 a year and a half ago, that's ridiculous. Well, is it when it costs you 260 to build it today? Like there needs to be a spread to take on development risk. And so that's kind of how we can justify your point. Like we're dynamically watching where replacement cost is going and know that there needs to be a spread between the two.
Well, and the flip to that is that, people are saying, well, it's cost whatever to build. I mean, how are we going to make any money if it costs us $250 to build a garden product? Well, because you're going to trade it at $330.
Right. And those, and by the way, those comps didn't exist 4 months ago, but now they're on the board. And I said this about Atlanta because you were just talking about Atlanta. We do a lot of work down there. And we've got a really cool, I mentioned earlier, we have a cool OZ site that I'm hoping we're clearing diligence on, and it'll be a game changer for us in that market. But, trades in Atlanta are for infill Atlanta, 400 a door is a new 300 and 500 a door is a new 400. And that all happened in the last 120 days, right? So all these trades keep getting posted and the bar just keeps moving up. And here in Charlotte, we just posted the Hawk here just down the street sold, what was that? 630, 680, something like that.
Yeah. 660.
We'll pick the midpoint, 660. I mean, that's crazy for Charlotte, 660 a door. It's really awesome product. It's super high rents, boutique deal, but just to throw something in the six handles is crazy.
We sold a deal last year in Kissimmee, Central Florida, Orlando, basically, and $255 a door. It closed in May, and at the time, it was a record for that. Osceola County. It was a record price for Osceola County. I mean, at 100 today, I guess. It's like by the time developers were getting under contract, they had seller's remorse. During the middle of the contract period before they even closed. We had people tell us hey, if they dropped a deal, we'd actually like for them to drop the deal.
Said no one ever, right?
Right.
I mean, and that's, so Florida is such a interesting beast because we're active there, as you mentioned, and my colleague Kyle, I'll give him a shout out. He's been very prolific in expanding our footprint in the Florida market, but we broke ground on that deal with Rise you mentioned. And, we have a very attractive land basis compared to, we didn't think so up until about 4 months ago. And literally there's trades going off up and down the street for double our land basis. And suburban land bases in Florida, certainly Jacksonville or Orlando, Tampa, maybe not much Orlando, but certainly Jacksonville and Tampa, 40, 45 a door for suburban garden product, which is crazy to me.
We have a site under contract north of 50 a door.
And that's, so 50 is going to be the new 40, which is the new 20. Yeah. Right. It's
yeah.
And does that, and I have this question in discussion with several of my peers here that are in the Carolinas and Georgia. We're like, that has to come up here, right? That trend has to make its way up to this part of the country. We haven't seen that. I mean, maybe you guys have seen more of that on the cutting, on the tip of the spear, that you're starting to see that, but we haven't. 50's crazy, but when somebody posts a $50 trade down in Orlando and you have a $40,000 unit trade here in the Carolinas, you're like, well, at least it wasn't 50 like down in Orlando. Right. And that's how we justify things, right?
But it's coming your way, though. I mean, everything kind of sort of moves. It comes through Florida, and then it moves up into the rest of the Southeast.
Yeah, we're there. We're not in the 50s, but we're hitting 40. So it's interesting to see the progression.
Well, this is Bryce. This is typically the point in the interview where I throw the script out and just go off the cuff. So you mentioned AI and rent growth. So please expand on that, because I'm totally ignorant on that topic. And I'm sure a lot of the people who are in our world are not very familiar with that concept as it relates to, real estate.
Yeah. So I would say another hallmark of Origin, between being flexible and creative with our capital, is that we're just always trying to innovate, push the envelope, and that comes from the top. It comes from Dave and Michael, but everybody within Origin embodies that. And so in COVID, we had a couple things we weren't doing a lot, at least for the first 90 days. We kind of blew up our pipeline and said, all right, what are we going to do until we have some idea when the world's going to stabilize? So we had to come up with a couple ideas that, we had been throwing around internally, and we had two kind of big ideas that came out of COVID. One, which I can get into later if you're interested, but Tom Briney, my colleague in Denver, spearheaded our entrance into the Freddie Mac K-Series bond buying. So we are officially, in a short period of time, have opened the velvet rope out, because it's a very small group of folks that can get in there and get on the primary auction space and buy Freddie Mac B pieces. And in a year's time, we were able to get into that club, and I'm very excited about that. The second kind of big idea and thing we were working on was incorporating data science into our daily lives. And I had built a couple of rudimentary risk models for us. Back and when I was at Deutsche Bank, we had a great research team there, and they always were building out their own econometric models. And it sounds probably more sophisticated than it is, and has become way more sophisticated of a science than what it was. But it was a lot of mashing of data. It's supply and demand fundamentals, population growth, job growth, all the drivers that go into creating the hamburger meat, right, into what makes a real estate, the fundamentals that we all look at. And so I created some element of that at Origin, and we were looking at kind of momentum factors. We were looking at liquidity in markets, because that is a big determinant of cap rate volatility. We looked at cap rate volatility of itself. And so we had taken all this, so we had built this model out, and we created our own kind of discount rate segmentation based on all these risk factors, where property was located, looked at the underlying business plan of the project, how much risk was it. So we had this model, and we're like, we need some talent to tell us what are the correlations between these various pieces of data, because we were just taking weights and kind of feeling our way into, if you move this lever by this much, does it produce the right discount rate? We're like, we need to supercharge this with some talent. And we found two incredibly brilliant data. They're at University of Chicago. One is an actuarial science major, and the other one's specializing in spatial analytics. And what spatial analytics is, and I didn't really know what it was. And frankly, there's very few groups in the country that we found that are using spatial analysis in their forecasts. And I'm talking about stalwarts, like the industry leaders, RealPage, Axiometrics, Reese, CoStar, Freddie Mac's research team. No one that we know of that we found is using spatial analytics to forecast in their models. And so this is truly cutting edge stuff. And like, to give you a cool, for instance, there's algorithms that we're coding and programming to figure out how these variables all correlate with one another, right? You're measuring the distance and this is where my knowledge of statistical analysis and spatial analytics breaks down, right? But you're measuring the distance between points, and you're figuring out regressions between them. And I'm sure if Ryan and Andrea were listening to me right now, they'd be like, "You are totally butchering this." But what they've done,
you sound like a genius, Todd.
But they've built these algorithms that really kind of test which variables are most correlated in a given location to rent growth. So it's a lot of back testing to kind of tweak the model. And through machine learning, basically what it does is you set up the algorithm and you just let it go, and it's going to run literally hundreds of thousands, millions of simulations to figure out the right best fit models for pieces. So we have 4 to 5 million pieces of data. I mentioned that we jam into this universal data set, and they pull from all of this, and they figure out which of these values are going to determine how likely rent is to grow in a particular location. And we back tested it, and to kind of put it in layman's terms, what you do is you look at what existed in a certain submarket, and we'll take south end of Charlotte just because we're sitting in it right now. what variables between incomes to rent ratio to underlying demographics to so affordability is a huge component, right? So how much more rent can people afford? But more likely, how many more people are likely to move into a given area that are wealthier? Because that's what backward-looking data misses. People look at affordability and they're like, okay, I'm going to take the census tract AMI for this location, divide it, and I'm going to take my rent and divide it by, and if I'm within 33% or less, it's affordable. That tells you backward-looking data, but that's not telling you about the people that are moving in there or who would likely move in there to change the dynamics of the demographics in a particular place. And so what we've done is we've looked at submarkets where you've seen rent growth, real rent growth throughout the country. What are the elements that existed in that soup that created explosive rent growth over a period of time? And then we look at the elements that exist in a place. We also make some forecasting of likely immigration trends to change the demographics and what's going to create, how much momentum is there to then generate future rent growth. And that's kind of the nuts and bolts behind it. And it's super cool. And the second best part of this is that we found a way to establish a starting rent. So in the model, there's three variables that drive, an underwriting model. Your starting rents, how much are you growing those rents, and then what are you selling that for on your reversionary cap rate? That's real estate investing in a nutshell. Right. Hardest part to get right is the starting rents and then the rent growth. And we've gotten that down pretty good. I mean, if you look at we have a report that's generated that's you put in the inputs, you put in the address, you put in how many units, you give a rough starting market rent and where you think it's at, and then the model just takes over and does its thing, and it gives you where we should be underwriting based on the number of stories in the asset. So if it's a 3-story versus 5 versus 10, it changes. It knows how to pick up high rise versus low rise, and it sets different parameters around that. But it'll tell you $15.88 or $15.88 is our starting rent per unit in Belmont, North Carolina, for a 3-story garden product, and it's going to grow on average of 4.8% a year for the next 5 years. And we back tested this. And I'll leave you with how do we end up relative to, we use Axiometrics as a benchmark because right now they're the industry leader. Axio in 21 thought on the nationwide, the rents would grow about 1.2%. What happened? Well, 10. They grew at 10%. In a lot of markets, they grew at 20 to 24 to 26. And if you go market by market, we were a lot more right than Axio was, about 600% more right, but we were still wrong, right? But in a normalized, non-anomalous market like we were last year, right, we're about somewhere in the high 90% accurate range from our forecast to reality, which is great. But we're living in unprecedented times, and will we see another 22 to 24% rent growth in Tampa and Jacksonville next year? Probably not. Is it still strong? Still probably 7 to 10. Yeah. And then from there on out, we don't know.
Cool.
But
so when we're putting together our OMs, can we look at like Axio and then your model and whichever shows the higher rent growth?
Sure. Just go ahead and pick ours. Yeah. Or pick whichever one is higher, because that's what you'll do anyway. But
Perfect. Yeah. Cool. Well, let's take a little bit of a break here, and then we can reconvene and wrap up our conversation.
Multifamily Method is powered by Capstone Companies, the largest privately owned multifamily investment sales brokerage nationwide. Capstone Companies provides dedicated coverage to both primary and secondary markets throughout the Southeast, Mid-Atlantic, and Midwest regions of the United States. Whether buying, selling, or refinancing, Capstone Companies is here to help. Simply put, Capstone is expertise, experience, extra mile. If you're interested in having Capstone provide a complimentary opinion of value on your multifamily asset, please visit us at capstone-companies.com.
Well, welcome back, Dave. We talked a little bit about Origin's origin, I guess, and we talked about, I guess, buying 110 single-family homes in Cape Coral, which is a great segue into talking about a topic that everybody seems to want to talk about in our industry, which is the build-to-rent space. So I know you mentioned you wanted to talk a little bit about it. You guys, I don't know if you're in the space yet or trying to get in the space, but interested to hear your take on it, and then maybe some of what your data scientists are telling you guys about the space moving forward.
Yeah, I mean, we're not in it yet. To kind of give you some fun historical context, our colleague and former colleague in Dallas came up. We're all about innovation and entrepreneurism and pushing the envelope, and we charged him with coming up with something innovative. And this was 2017, I think, maybe 28. If it was the end of 2017. And he's like, hey, I've got a site in infill Dallas that I can do some townhomes on. We can do about 60 units. I've priced it out. We can do this. It's going to be super cool. It won't be for sale product like everybody's used to. We'll rent it out and we'll crush it. And we didn't jump on it as a firm. And he brought it to us. He brought the idea. He was just early, and we should have. That was kind of our little bit of our miss, right? We should have kind of gone deeper and could have been on the vanguard and cutting edge of what has become a crazy trend in our space. But I will say that through that process, we got in early on. My colleague Tom Briney, who's in Denver, started picking up on a build for rent portfolio in Phoenix, and he got us all down there. There's a developer named Christopher Todd Communities, was one of the first build for rent scale developers in the country. And his story is interesting in of itself. He was a bread maker and sold his bread company for a bunch of money to Whole Foods, and decided to get into the build for rent space and learned a lot about it and made some mistakes early, but has found a way to effectively franchise his model. At least that was his intent at the time. And we tried to get in early and stake him and really, give him venture capital. He asked for venture capital, but growth capital to fund his pipeline of deals, and we couldn't ultimately get to terms there. So I only say those two stories because we've been trying to get into build for rent for a while, and as you guys have seen, the capital has completely flooded into that space, and you've seen a lot of groups that are backed by large private equity funds, whether it be KKR has I think a big investment, and Goldman, Morgan Stanley, JP Morgan, they've all kind of picked a horse to back. And so part of me wonders, well, how much is left out there for the groups that aren't backed by those large venture capital or private equity funds. I still think the demand set is huge for the product, and if you look at who's renting there, and the Catalyst team here has some really good insights on that, because they had a project that was very successful up here in Concord, and we looked at partnering with them on a project up in the university that they're going to be building, and what we saw through some of studying the demographics of the folks that are there. It confirms, and we've seen this on other projects that we've gone after too, on who wants it. Well, basically everybody wants it. It's older generation, the retired generation wants it. The millennials want it. They want in some cases, they want out of their conventional 3, 4, 5-story stick-built multi-deal that they've been in, because they want a yard. They want some more space. They want some verticality, but not, within their own box. They want, they don't want to be on one level in their unit. They want to be able to go upstairs, and
they're starting to have kids too.
Right? Every millennial's got a dog at least, and now have a kid. So it's attracting a pretty wide segment of demand. So it makes sense why capital wants to be there. And the hardest part, frankly, in a lot of cases, is finding the land cheap enough to make the math work, because it's low density. Talking about 10 units per acre, right? So you're not talking. So to build a community of size and scale, and we're looking at projects for them to make sense operationally. they generally need to be about 150 units or larger. That's what most of the property managers will tell you too, that are in the space and doing it well, is that you need to have that size to have scale. So let's think about that. So if you're building 150 units at 10 units to acre, in some cases you may be a little bit less or maybe more, 15 acres of dirt, that's a lot of land. And finding that in locations that where people also want to live, that's the hard part. And then also having the entitlements to build that in those locations as well are challenging. So I was just joking at the break. We always make the comment internally, or at least I do, that there's 10 to 1 amount of capital that there is available deals right now. There's so much money that wants to be in the space, and there just aren't enough opportunities because of all those conditions I just mentioned. We're trying to get in. We've got active term sheets out. And I should say, I'm kind of misspeaking a little bit here because we actually do have a deal under control. I mentioned Geffen earlier out of Houston. Yeah. We have a built for rent site in Austin that we closed the dirt on. So we will have that will be our first built for rent. We're still in the design and planning stages, but we own the dirt, and that will happen, and that will be our first. But right now we don't have anything that's actively under construction.
Have you tried to do like the big shops have done and just sort of try and pick a horse and just ride shotgun with them, or are they don't need your money because there's so much of it out there?
It's more the latter. We've had conversations with a couple of groups, and admittedly, we have strong access to capital, but we're not a multi-billion-dollar fund. So sure. They're looking at they being the local developer, regional developer, saying, if I'm going to do something, if I'm going to hitch my wagon to you and do something programmatically, I want to make sure you got oodles of powder. Like, let's go, let's scale this. And I think realistically, we can probably fulfill the needs of some of these regional groups because they want to do 10 starts a year, but they're only finding enough dirt to do 2 or 3. And that's frankly perfect for us. Right. So I think it's more their phones are ringing off the hook. They're getting bombarded by, either brokers are like, hey, I can line you up with capital, or capital's reaching out direct and finding them and saying, let's go make a deal. So we haven't found it yet. And I'm going to make one more anecdote on what's happening in the market. I was with drinks with a few real estate guys right before Christmas here in Charlotte. And the concept that was flown out there after a few beers was a term I've never heard before, called the double forward. And this exists in the build for rent market, but probably in the industrial market too, where the concept is this: you have a project that is under a build for rent project that is zoned and entitled and ready to go, and you go offer basically a value to buy the dirt out at effectively a double the land basis that the group that has it under contract, hasn't started construction yet at. And then you turn around and you flip that to another group and make a profit in between. So you're literally not doing anything on your own. You're just tying something up and skimming it and flipping it and making more money. And like, it just kind of goes to talk about where we're at in the cycle and how limited opportunity set there is for land where you're making the double forward, where you're flipping your own contract out for a profit, which is it's pretty wild.
That's amazing. We're definitely seeing a lot of attention in that space, and we were working on the deal you mentioned it up in the university, and just saw a tremendous amount of interest there.
It's the product du jour, no doubt. But I actually think that I've said to a few folks like this, I'd be happy to go out in retirement on this product type. I think there's going to be demand for the next 20 years and then some, especially in our Sunbelt markets. It's a great product. People want the lock and leave lifestyle, but they want all those things that we talked about. And there's a reason why there's so much capital that wants it. Because,
but to your previous point, though, it's going to create more sprawl, like in Florida, right? I mean, you're going to be, like where I sit in Tampa. I mean, we're already, suburban markets like Wesley Chapel and Zephyr Hills, which are 45 to an hour from the city, are starting to see all kinds of development. But like to get 15, 20 acres to make a deal work, I mean, you can barely find a site in Hillsborough County to do conventional multifamily without having to assemble it. So, I mean, to look at like build for rent, I mean, you're going to be going further and further out
Well, yeah, and I think where you start to see, and the home builders I've realized this too, right? Lennar as a great example, where here in Charlotte, that they've started their own build for rent division. I think they have a portfolio or a pipeline of over $1 billion worth of product. But the beauty of Lennar is that they control the land, right? So they have so that's where I think a lot of this is going to go. Is you're going to see the large home builders who have huge tracts in subdivisions, and they're going to do their thing with building conventional single family homes, but they're going to carve out a piece of that for either themselves to do it, which they can do it more cheaply than cheaper than anybody else can, just given their economies of scale, or they'll sell it off to a build for rent developer, knowing that they can get a huge premium on the per lot price that they could get even if they were to sell it.
Right.
So I think you're going to see, that's a great point you bring up, but I think that's probably where this is going to naturally, organically exist, is within the confines of a conventional single family home community.
Tell your Florida guy all he needs to do is focus along the I-4 corridor. For that kind of product. I think you can fill up the corridor. I think in 10, 15 years, the space between Tampa and Orlando will be negligible. It will be basically one massive metropolis.
Yeah, I mean it's and he's made that comment before, and I've heard that same thing too. But it's crazy when you drive it now, because you're like, there's still definitely farmland there, right? The stream songs out there, which is pretty cool. But yeah, I mean it's I believe it, because that's where people want to go. It's affordable, and again, that's the lifestyle they want to live.
Yeah. Cool.
Yeah. Well, shifting gears just a little bit, talk a little bit about current day, Dave, with all the verticals that you're chasing and ability to get capital out, and the new BTR initiative, not new, but BTR initiative, plus your responsibilities as a husband and father chasing the kids around. What's a typical day in the life of Dave like?
I mean, how early do you want to start? Like personal life, it could vary day to day in terms of between my wife and I, who's getting our oldest out of bed, or if we're tag teaming that. But usually I've got 3 boys and ages 7, 5, and 2.5. So getting them up and rolling is kind of priority number one. And school starts about 7:30 for our oldest. So sometimes it's me dropping him and then going into work, or waiting until the other 2 get up, seeing them for a little bit in the morning, and then doing some emails from home, and then maybe get on the Peloton, trying to break a PR and not have a heart attack at the same time, and then find my way into the office. And it's fun. I tell people I'm blessed in that the old axiom cliche of find what you love to do and you'll never work a day in your life. And I think that's so true. I truly love the real estate business. I love the people that we work with. There's nowhere else for me to be career-wise. And I feel for people that are like, I hate my job, I'm stuck in this career. How am I here? I think I'm super fortunate, because I love physical assets. Like, I've always been enamored with architecture and with buildings, and then I find out that the people in real estate are generally all really pretty good people, like to have a lot of fun. So I enjoy my job, and my day could be wildly different depending on the day of the week. If it's an investment committee day on Tuesday, it's a couple hours going over our, any one of the deals that we have that are in various stages of either sending out term sheets or in due diligence summary memos. So that's usually a pretty long process on Tuesdays. Mondays are, we've changed our cadence. So I mentioned investment committees on Tuesday. It used to be on Monday, followed by our all company meeting. And I'll say that was the single best change we've made as an organization, at least for our team, is that we moved committee to Tuesday. Because what that did is it gave us our weekends back. Because underwriting doesn't happen when you're traveling to markets and looking at stuff. A lot of times it happens on the weekends, especially when you had to produce a memo for discussion on Monday. So that meant my team was working on Sundays. So moving that, and we did that last year, moving that to Tuesday was a complete game changer. So now Mondays suck, but Mondays suck always for everybody, right? I mean, Sunday scaries are a real thing, and you're going to have them 10x more when you've got investment committee the next morning, but much less so when you know, okay, I'm going to work a long day on Monday to get this memo out because investment committee is on Tuesday. But it could be, any one of those things. I host, or I've been pulled into some webinars with our principals in Chicago to communicate to our investors on any one variety of our funds and how they're doing. So there may be some webinar prep in there, actually doing the webinar itself. Traveling to our markets, it's a big thing. I mean, I obviously need to make sure that I am player coach. So, I cover the Carolinas and Georgia, but I also sit on an investment committee, and we have deals in multiple markets throughout the country that require some travel. COVID's kind of been weird, certainly from that, but we've managed. I'm still been traveling and less than I was, but still doing it. And then, spending time with my team, making sure that their needs are being met, and we work remotely. So COVID has changed nothing for me. I've been in remote in Charlotte myself for the last 7 years. So I've always been doing the Skype before, and then it was the GoToMeeting, and now it was Zoom, and now it's Teams. But the brands have changed, but the concept has been remaining throughout. And frankly, this hadn't affected me really one bit. So,
do you have anybody in Charlotte with you, or is it just you in a?
You're looking at the Charlotte office right here.
Okay.
And it's the same format in all of our. You go to Nashville, it's just Kyle. You go to Dallas, it's just Phil, and in Denver, it's Tom. And we're going to change that. I think we're going to probably move some folks on the investment management side to be in those regions too, because as we're developing more and more, having them in their markets too. Development process is a long time. It's 2 years generally, and to at least to build it, and then another year or so to stabilize it. So having folks that are boots on the ground on the investment management side is key as well. So we're going to probably be staffing some folks, and we do have a gentleman who's on our investment management team who's in Atlanta. So we already have that to a degree. He's on his own down there, and he covers the Southeast with me.
Got it. So we talked about your labor of love on the Noda deal. Would you consider that your biggest success, or is there another deal or initiative that you've implemented since you've been at Origin that you would consider your biggest success to date?
Yeah. So deal guys always and gals always love to talk about deals, right? I would say that I'm also a manager, and far and away my biggest success at this company has been retention of our team. And I mentioned that at our company year-end presentations and goal setting and planning for 22 in Chicago in December. I said that is far and away my biggest success, is that I showed our org chart, and we've got a senior associate named Jacob Soika who's a total rock star, and that seat has been vacated consistently over in a kind of a 2 to 3 year period for the last decade, because we promoted those individuals up to become market officers. And the fact that we've been able to have Tom come through that seat, who's now managing director and out in Denver, and then Kyle, who's in Nashville, Phil, who's in Dallas, they've all come through that seat in Chicago and have moved to their markets and have done incredibly well. And I do believe that Jacob's on that trajectory, and that's a 10-year period, and we've had very little turnover. And we've been hugely prolific, very efficient, and then integration now of our AI into our process. We've done some great things, but far and away, just keeping a great team together has been my biggest success.
Yeah, and it helps to hold together a culture.
Yes.
Too, right? I mean, we talk about that a lot. It's the biggest thing that we talk about at Capstone is our culture. And I don't think we've ever had a broker leave for another.
Which is incredible. Yeah. In a business that I wouldn't say is notorious for it, but there's generally some trading out from, flags here and
notorious.
There.
But
that's a big testament, right? And it's exactly what that is. That's culture, and creating an environment where people like the people they're around. They're challenged. They wake up every day. They like what they do. I mean, I think part of it is we do so many different things. It's kind of hard to be bored at Origin.
Yeah. Yeah. If you're bored in our business, you need to go do something else.
Yeah.
Yeah. What are you working on now that you're most passionate about?
I'd say probably this deal in Atlanta, which I can't talk a ton about. I'll give you the kind of the specifics. I won't tell you exactly where it is, but it's a 40-acre site, South Beltline area. So gentrifying location within Atlanta, but still very much infill. OZ deal. So it'll be a 10-year hold plus, multi-phased, probably 1,500 to 2,000 units in total. Maybe 100 to 125,000 square feet of retail, commercial, but it's going to be super cool. We have a master architect and designer picked out for it, who's perfect for it. They think about the dirty things that nobody loves to talk about in development, but that are really critical, which is the stormwater detention and how to make it cool. Like turn that, what otherwise you bury it and it's expensive, and turn that into a communal lake, in this urban community, not lake, but a large pond, put some trails around it. So we're going to do some really cool things with that. We've engaged the community early on. We're trying to preserve some of the existing structures that are on place, on the project currently. And we're trying to create something that's unique, for the city of Atlanta and for the folks in the neighborhood. And I'm pretty excited about that.
Awesome.
So where, Dave, and we talked a little bit about your past, obviously, and your passion for the industry, your passion for Origin. Where do you see yourself 5-10 years from now?
Well, if we want to keep geeking out on technology and data science, we will continue to do that at Origin. And you guys may have heard about this in the last probably several weeks or months, but the metaverse, has this become entering your lexicon where they're selling real estate in the metaverse, which blows your mind?
I can't wrap my head around it.
So digital real estate, right? One of our co-founders, Michael, and I got into crypto early, and I was up in Chicago a week or so ago, and he was talking about the metaverse, and I wouldn't be shocked in 10 years' time if this becomes a thing. Origin has a metaverse fund, right? We're selling digital real estate to folks who are owning real estate in the metaverse. Wouldn't be shocked. I say that somewhat tongue in cheek, but you never know. I think what we'll also be doing, and I'll be spending time, I've been really fascinated by 3D printing, and we're kind of on the early stages of that yet. The construction industry, and we started thinking about how we started this conversation about all the BS that we're dealing with in that whole industry. Guess what? That hasn't been disrupted for 70 years. We're still building stick-built apartments the same way we did in the 1950s. Name me any other industry in this country that hasn't been completely disrupted by technology. This is it, right? Like we are living in the dinosaur. And I think that's about to be totally disrupted through 3D printing. And you go down to Austin, they're doing it already, with affordable houses and tiny houses. We're on the cutting edge of that. Is it 3 years from now, 5 years from now? Probably more like 10, but it's coming. And that's going to be, we'll be on the front door of that too, watching how modular or certainly 3D in the longer future disrupts our business, but we'll be on the forefront of that. And, we'll be adopting it as quickly as frankly any group will be out there.
So, you've kind of addressed all this, and it sounds like you guys are very innovative and tech driven. I guess, what is the vision for what Origin will be in the next 5 to 10 years outside of some of these tech advancements, and you as well, like in particular?
Yeah, I mean, Origin, our vision, which we're actually getting together later this year to modify it because we're already kind of reaching our vision, right? we have a mission and we have a vision. The vision was, $1 billion in EUM, equity under management, which we will achieve this year, which is crazy. So we set that goal out a couple of years ago and put out 300 million last year. As I mentioned, we'll put out 500 to 600 this year. And then we have some closed-ended legacy deals that we're selling off. So you kind of take it 2 steps forward and 1 step back. But we'll be there. So now we got to figure out, okay, well, we've climbed the mountain to $1 billion in EUM. Where do we go from here? So TBD on that for Origin once we sit down and do some kind of long range planning. But our mission really has been to enhance and change the way individuals invest in commercial real estate. And so that's really been our goal all along, is to provide high quality real estate investments to the retail, the smaller and accredited high net worth investor that have been afforded to pension funds and endowments for forever. And we're kind of democratizing the way people invest in real estate. Like our minimum investments in most of our funds are $50,000. When we first started Origin, we were much higher than that. We were, I think Fund 1 was, if I'm wrong, at 500, it was 250. So not exactly available to the masses. And I'm going to be honest with you, $50,000 is not available to the masses either, but it's certainly a lot closer to the, of a wider swath of investors than what was typical historically of $500,000 to $1 million to get into a diversified fund. So that will remain our mission. And that is what drives us to come up with unique investment products that we know investors are going to like, that are tax efficient. And that's what maybe takes us to the metaverse at the end of the day.
Well, it's really cool. It's, you guys definitely have a unique operation and setup. I think can the podcast hosts get in at 50K level?
Oh yes, sir.
Is that
just got to be accredited. Yeah.
Okay.
And I won't see your tax returns. Don't worry. We have a third party that verifies all that.
All right. Perfect. All right. Well, wrapping up here, we like to do a little rapid fire at the end, ask you a handful of questions, get you to, kind of to think on your feet and give us your best response. Bryce, I'll let you kick it off with the first one.
Yeah, sure. What is the best book you have ever read that really impacted you?
Elon Musk's biography. I'm fascinated by, as you can tell, I'm not a true futurist, but I'm fascinated by futurism. And I read in books and watch videos on the subject, and I don't think there's anyone who's more driving us faster into our future selves than Elon Musk. And everything he does is about colonizing Mars. I mean, Tesla is a byproduct to create batteries to power the spaceships that'll take us to Mars. And just hearing about his background, and he's a badass. Like, listen to it, read it. It's fascinating. If for nothing else, you might think he's a blowhard, you might think he's an asshole, whatever, but like, he's entertaining and he's brilliant.
Yeah. Yeah. What podcast are you currently listening to the most, other than, of course, the multifamily?
It's funny because I do a lot of Audible for books. I don't read a lot, like hard books anymore, and I'm listening to probably 6 or 7 books at any one time. I have terrible ADD, can't quite finish anything. But I was thinking the other day, is like, I don't really listen to a lot of podcasts. I don't know why, because I do find value in the few times I sit down with them. But a few that I found interesting is David Goggins has a podcast who's pretty interesting, pretty vulgar, former Navy SEAL, but he's got some great guests on there. And then there's also, I'm pretty sure there's a podcast by, is not Leif, who's the other Navy SEAL guy that Leif Babin, I think is his name. But he's got a podcast on, and anything like some of those, anything related to Navy SEALs, I find fascinating just because of how they're trained and hardened into battle. But they're so driven by system and process. That's what I like. Right. Everything is done. There's a reason for literally everything that they do, and you can apply that to life. And I clearly don't. But folks who do that have wild success. And I'd say Nick Saban, although Monday night excluded, has applied that level of discipline to the way he coaches. And I just admire anyone who can. I know I'm not answering the question in terms of podcasts because I don't have a good answer for you, but anyone I can surround myself in my orbit of people who adhere to a discipline, it really impresses me.
That's great. What one piece of advice would you give someone, or that has been given to you along the way to get you where you are today?
That's a good one. I don't know if there's any one particular piece of advice, but one thing that has been, there was a gentleman at Deutsche Bank that I worked with named Bob Cook, and called him Uncle Bob, Professor Bob, because he literally was a PhD at Wisconsin. And he would sit around the investment committee table, and there'd be a bunch of people with, kind of yelling at each other and talking about different ideas. And Bob would just kind of sit there and watch. And then when it got quiet, he would make a statement that would completely change the course of the discussion. And it just takes unbelievable discipline to do that, and also to kind of rise above the fray. And he had this unbelievable ability to kind of cut straight to the issue. And I would say Michael Upscope at Origin has that same ability. Dave too is an incredibly brilliant guy. They both are, but Michael's he just picks up on things very quickly and kind of cuts through the minutia. And I would say that if you can kind of work on seeing the forest through the trees in anything, because that's a lot of life decisions or life issues that generally there's a core root problem or cause that you need to address or solve. If you can kind of peel back all the noise, you'll get to the right decision or the right direction or right course. And there's few people that are really skilled at that. And it's another thing I admire about certain folks. So see the forest of the trees. And the other one is leverage as it relates to our business. Debt is great. It can be great. But it amplifies things both positively and negatively. It makes a good deal better. It makes a bad deal worse. So just be careful with leverage, and when you can, go long, right? Because if you look at, I was listening to Peter Linneman, who's an economist from Wharton who does a lot of podcasts and webinars and stuff. And I knew this to be true before, but his team just did this. They took the Nareit index over 41 years and they peeled it back, and any 10-year increment you take, you didn't lose money in real estate. So publicly traded REITs, if you held for 10 years, you never lost money in 41 years. So that tells you, and generally REITs are not levered highly. They're well managed, they're liquid, but they have discipline to them. If you follow that as a private real estate investor and you don't try and market time, you don't over lever, and you don't put on short-term debt, you generally aren't going to get caught with your pants down. So put yourself in a position to ride the storm out, and you'll be all right long term.
Dave, this podcast is hosted by brokers. Please stop talking about holding long term.
Land sales, just keep churning those land sales.
If you can change one thing in your career, is there anything, and what would it be?
One thing in my career. Can I say nothing? Is that an appropriate answer?
That's a great answer, actually. Yeah.
What I would say is, maybe I wish I would have gone to an entrepreneurial shop a little bit sooner in my career, like Origin. But I wouldn't have traded my time at Reef for the world. I met some great friends that are lifelong friends of mine. Some were in my wedding, I was in theirs. Still friends to this day. We grew up together. We saw a lot of cool things. We went to school together. Maybe I was an analyst a little too long there because of the GFC and kind of kept me into my seat. But that's it. Maybe, what's interesting about being a deal professional in our industry is we always think that you need to have, and I say this too, that you need to be older and you have to have a ton of reps. And that's sometimes true, but I've seen it where you put somebody who's got real promise, talent, drive, intuition. You can assess that at whether you have that at a young age or not. You throw them into the deep end of the pool and they're generally going to swim. I would push anybody who's, of the mindset of you got to be, in your 30s to be a qualified deal professional. That's not true. You can have some very successful, young, hungry folks in their 20s. And frankly, we're going to have to go there because the talent war is real. We're struggling to find folks to take on all roles. And it's not just an Origin thing. It's across the board. And we're about to see a change of the guard, I think, in real estate, in our profession.
Well, thanks, Dave, for being with us today. Really enjoyed having you on the show here, all the insight and comments and just good conversation.
Yeah, real incredibly interesting topic. Really cool story about your firm. Stuff that I think a lot of our clients, listeners, partners don't really think about on a day-to-day basis. So really enjoyed having you on the conversation.
Yeah, guys, thanks for having me. It was a lot of fun, and I can be a little bit of a gas bag and go on for a while. So I'll be very interested to see how this thing gets chopped up and edited. But but no, really enjoyed it.
With me hosting it, so they're really good at that.
No, it was fun, and I'm happy you guys are doing this. I think it's great to get it out to folks, and the more insights you have into the human element of what we do, there's real challenges here in the industry and personally and professionally, but the more you get it out there, I think people enjoy hearing stories, and certainly ones that are relatable. And the other book, I know you didn't ask me on this one too, but if you want another good one to read or to listen to, would be Stephen Schwarzman's book, who's the co-founder of Blackstone. It's a book called What It Takes. And great book, especially if that Elon Musk was for the futurist nerd in me, but one that really applies to real estate and folks who are either in our business or want to get into our business. Blackstone is the envy of most folks and smartest folks in the room. But just hearing how there's snippets in there about how they run their investment committee, how they evaluate risk, and some really cool nuggets in there from the largest real estate owner in the world.
Awesome. Great stuff. Well, thanks again for being here, Dave. Appreciate it.
Thanks, you bet. Thanks, guys.
All right. See ya.
Thank you for listening to Multifamily Method. If you enjoyed today's episode, please give us a rating and a review on Apple Podcasts. It helps our podcast get discovered by other savvy investors like yourself. Subscribe to Multifamily Method for free on your podcast platform of choice. Find out more about Capstone Companies at capstone-companies.com. Multifamily Method is executive produced by Capstone Companies. Audio production for the podcast provided by Andy Go of Gojo Studios, and video production by Yash Mystery of Mystery Projects.